Alright, y'all, I'm out here in the middle of America. I said I'm gonna still get you your video, and we are going to talk negative interest rates. So I got flex on y'all. You can peep this swag real quick. We looked at some property. Dude, this thing is like, actually guess the price of that. I want to see if you guys could know, but I had to step outside for a little bit to make this video, and I'm in a neighborhood where I could you know, I'm not in my LA or Cali. So, but let's talk about negative interest rates. All right, I had to cut and backtrack. I need shade here. It's really hot. But negative interest rates. So I want to explain them. We had a talk on them on stream, and a lot of people got very confused at first with how they work. So I want to talk about one, just what it is, but then also why it would be a good thing. So we live in a marketplace today. We have a world. There is a few countries with negative interest rates like Japan and Germany right now. However, for us, you know, the concept of, you know, hey, you give me money, I'm going to give you less money back, that doesn't seem like an investment. However, we just haven't seen an environment or a situation where that should happen. So that's why it's probably confusing for most people, but let's get into it. So a bond, I have a video explaining what it is, but a bond is essentially you give somebody money, it's a loan, and they promise to give you all of your money back with an expected return. So if it's like a 3%, 10%, whatever, you know, you could either get coupon payments or you get it all at the end when the bond matures. So there's that aspect of it, but now a negative interest, or you know, a bond that pretty much you give me so a normal bond, let's say it's at 10%. I'm not going into the details of it, but a normal bond 10%. You give me $100 at the end when it matures. I give you $110 back. So a negative bond, let's say it was negative 10%. You give me $100, but then I would give you $90 back. Now that seems counterintuitive to most people, because how is that an investment? All right, so I figured it was too hot out there. It was killing me. I had to come back into our Airbnb, but I got lending tips over here. His kid's sleeping, so I got to keep it down. We were looking at properties. I needed him to pull some strings. He knew some people out here, and they said I had to dress up in a suit. But so the whole idea of getting less money back doesn't make sense to a lot of people. But again, we haven't been in that environment. So where does that benefit you? It is if the currency is strengthening. So this is where it gets into econ and all that, because a lot of people miss the ball here. The point of money is to get something, to buy objects, goods, services, all that. So if you get all of your money back and it allows you to buy more things than originally, you actually made a gain. So even though the amount is lower, you could still walk away. So in the case of if your currency strengthens, if I give you $100, and you give me negative 10% back, I would get $90. But now if the currency strengthened 20%, let's say, and that's a big amount, even though I would be getting less money back nominally, the number 90, I would have a higher purchasing power, so therefore I would benefit off of it. So then this begs the question, why wouldn't you just hold money instead of buying a bond and getting less money back? Because now, if you're in a negative interest rate environment, they want to spur the economy. So the charges essentially get passed on to the consumer. So if we're in a negative interest environment, your bank is going to charge you now to hold the money in there to spur activity and growth to get you to spend. So that's where bonds come into play, because they're a safe investment. So they're giving you two choices: either spend your money or give it to the government to use for government funding, and they'll give you a negative amount back. But again, if you're expecting, you know, a 5-year maturity, that currency is going to get you more purchasing power, you don't care if you get less money back, but now your money is safe. And now a good example of this is Japan. Japan has negative interest rates. And again, I've talked about them in our economy because they really relate to us. They are kind of our test dummy. They have led the way for a lot of our monetary policy with some twists, but they're the modern, I guess, guinea pig for us. But I went over this on the stream. I won't get too into it, but essentially there was the first lost generation East Asian financial crisis when Japan was the #1 economy. They dropped off. It led to all these problems. You know, Japan has a very older generation. They lost a generation of kids. People didn't, you know, because of everything that was going on and with the economy, they didn't want to have kids, and now they don't even have first-time home buyers. So what I'm saying is all of this leads to a situation in Japan where there's a lot of savers. So a lot of the old people save their money, and now you see Japan's currency has been strengthening, so think supply and demand. If the supply of all the yen is being held by the whole people, they're all holding it in their banks, that's going to make the value go up. That's why Japan's policy, they do yield curve, and they pump so much money into it to counteract this strengthening currency, deflation. So that's why by lowering the rates, the banks would want to get them to put the money out there and either spend, or they put it into the government and the bonds. So simply put, there is a benefit for it, and that's why when bonds start to go down, that is an indication of the market coming towards safety, and also what they think about rates. But essentially, when you see a rate go down, it's for it depends how big and how much, but that's essentially showing you that investors think the currency is going to strengthen versus weaken, because reverse this whole concept with inflation now. So if you're gaining money on the upside, it's, if your currency is going to be weakened, you'd expect to get more money back. So you'd need more money back just to get the same purchasing power. But as you guys see, it's very, very simple, but counterintuitive. So I go watch the stream. We went into very, very big detail about it, but for the most part, this was kind of the quickest summary I could give. But negative interest rates aren't bad. Now, the effects that happen afterwards and what it does to the monetary system, some would say it's unknown. We've only seen what's going on with Japan, Germany, I think Switzerland as well, but it is going to be interesting to see how it plays out. And coming into what we're doing, I'm going to make another video on the rate hike, the rate cut. I'm going to show you guys a really, really cool thing. But at the end of the day, the negative rates, and this should get you guys looking into the currency, but how it's relating to both policy, economics, the stock market, all of that. So that's it. I won't ramble too much. That was quick, straight to the point. I'm going to get back to this creepy Airbnb that looks like I'm going to get murdered in it. And yeah, I'm going to go edit this video, and I'm going to go get to my meeting. And I love you guys. Have a good weekend. We're still going to get the watch list tomorrow. I will be home. The market is crazy. There's a lot. Look, I'm pacing around. I'm getting too hyped. All right, I'm going to leave you guys. Peace.